Thank you so much for joining us this Wednesday. Whether I've spoken with you, you've seen, our faces around the internet, you've attended one of our other webinars, or you're a current investor, for joining Chris and myself. But I want to talk about, in the last two webinars we've done, we've talked about, our offering, the structure of it. And then the second one we did last month was all about note investing. So the underlying assets, any risks associated. So if you haven't checked those out, they are posted on our YouTube channel. Feel free to go check those out. But that being said, I guess we can get started.
Yep.
Okay, let's go ahead and do that. So welcome everyone. Like I just mentioned, we are 70 Investments. We have an offering that offers 8% annually paid as monthly dividends, while also trying to keep borrowers in their homes. So we've talked about that, and you might have seen that around. You've seen it in emails, you've seen it in our messaging, but what does that mean? So we wanted to run a webinar today to, just briefly cover two actual case studies where we kind of walk through the numbers behind that. How does that work? What does that actually look like? What are some of the borrower situations that we're faced with? And what are we doing to help the borrowers stay in their home? So with that being said, Chris, do you have anything to add?
Only thing I'll add is we have to start off every webinar with our disclaimer and disclosures. So just want people, they can read this, but we just want to highlight this is not legal advice. We are not CPAs. The material here is for informational purposes only. And feel free, there will be a recording of this, pause the screen and read this in its full entirety. Anything else you'd like to add regarding the disclaimers at all?
No, I'm good.
So one of the things we do get asked a lot is, how do you create that win-win situation? What is it that we do? We get lots of questions that come up about whether we're buying the house, we're buying the note. And today, like Lauren mentioned, we really want to walk through what it is we do, because note investing is not something that people may be familiar with, or it's something that's off the shelf that is, very easy to learn about. So we really wanted to walk through two case studies, like Lauren said today, to talk about assets and how we resolve them, because one of the questions, again, that Lauren gets asked a lot is, well, how do you make money on something that is not performing? So this first case study I'll talk a little bit about was a loan that had the borrower owed $86,000. And they had roughly a $965 payment. Their interest rate was at 10%. And the property value was about $110,000. And this loan was actually originated in 2010. And when we acquired this back in 2018, basically they had paid down some of the loan and the property had slowly appreciated during that time. And some interesting facts when we were looking at this loan, it was behind by about a year. The person had been paying for about 7+ years. And as Lauren has mentioned on other webinars we've done, we talk about the 3 Ps, the person, the type of borrower there is, the property itself, and then the predicament is what caused the situation, because those 3, and taking a 3D image of that, really can play a role. And is it an asset that we want to acquire? And what is our strategy once we acquire it? And as I mentioned, they had been paying for 7+ years, and the property was well maintained. And the predicament was the borrower had gotten cancer and had to go on disability, and they were not working. And for anyone who's ever been on disability, there's a process. It just doesn't all of a sudden you get a check the next day. And with I think the number is over 50% of Americans living paycheck to paycheck, missing that paycheck can be, catastrophic for some people, because they can't afford those bills. And we knew this information because the seller provides us with the information, which is called the conversation log of the servicing company. It's a company we use that collects all the payments. They give us that information so we can paint this picture of what is going on. And This was part of a larger pool that we were acquiring. And, like if you can see, we paid, a little over 50 cents on the dollar for this asset because it had, been delinquent.
So one thing before you move on, Chris,
Yep.
just like you had mentioned, where we get these numbers, where does the loan payoff come from? So when we are looking to purchase an asset, we get what's called a tape, which is a list of all the assets, and it breaks down all this information for us. So the loan payoff is essentially everything they would need to pay to, pay off that lien. The payment is, principal and interest rate, all of that is listed there. And that's what the information that we use to do our initial calculation on what we would pay for this asset.
Mm-hmm. Yeah. So one thing before we go to next slide, I want to touch upon, because I know we're getting this asked a lot lately, is what happens if property values decline? That is something that I think a lot of people have on the back of their minds right now. And when you look at the numbers, the borrower has equity in the property because they owe a little over 85,000 and the property is worth 110. If the property dropped by 20%, which would be 22,000, they're basically going down to 88,000. Basically they'd be at equal equity on the property. If it continued to drop, the borrower may be upside down on their loan. But when you look at our acquisition price was 55% of that. So in this instance, if property values dropped by 50%, the value would still be 55,000. Our acquisition price was 45. The initial equity is still protected within a significant price drop. So I just wanted to point that out as well.
Yeah. And, I know I'm having a lot of these conversations with people about that. Like you said, this question is coming up a lot. So really, we are constantly evaluating the economic climate, looking at, what's happening around us and adjusting our bids accordingly. So always making sure that there's more than enough equity, even if something, drastic were to happen, that our acquisition price makes sense.
Yep. And to go along with that, Lauren, my email over the last 3 days, my inbox got completely, I'll say, pummeled with emails from some of the companies we use, because at this time of the year, we send companies out to look at every single property in our portfolio and to look at, confirming, what's the condition? Is it still occupied? Kind of get an estimate of value. So we know at any point in time what the values are of our portfolio for these assets.
Yeah. So it's not just upon, that's a good point. It's not just upon acquisition, but it's also after we've acquired it, making sure that we know where all of our portfolio is value-wise throughout the year.
And that's something that, as a company looking to raise 75 million, we can do that. If, the larger firms, the billion-dollar firms are much larger, when they have tens of thousands of assets, it's much more difficult for them to manage on an individual basis. It's more of a portfolio basis. For us, this is where, we add that extra layer. So we talked about this asset. So how did we create this win-win resolution? And first, like pretty much any type of resolution, communication. And we reached out to the borrower, had our servicer reach out to the borrower, communicate with them, and they had requested if we could continue to delay payments for a few more months to get their feet back on the ground. And because it was in a state that had a lengthy foreclosure process, the borrower had the equity. This was kind of the borrower had not shown a consistent path of a repeat offender. He had family helping and living with him during this time. So, we trust but verify. So we did, allow some of that delay payments. But we did, basically start by sending also a demand letter, just in case they didn't come to fruition, that, it allowed us reserve our rights. We also modified the loan payment down to $775 when we took some of their past due payments and rolled into a modified loan. And by doing that, it gave them, a little extra comfort. So anytime you can, get your mortgage rate go down, I think everyone find that be a benefit. And, they were, happy with that, of course. And it still made our numbers work. So that's one thing. Again, we're always evaluating, where the numbers need to be to still, make the numbers work. And the outcome was the borrower did get their disability. The borrower completed their treatments. They got back to work, and they continued to make that payment. And after about 2 years of holding this loan, we had the borrower continue to make payments for over a year plus, which is considered a reperforming loan. We turned around and we sold this loan on the secondary market for over $60,000, which netted us, an annual return over 20%. And one question we get asked a lot, part of that is, well, who do we sell to? We sell to other investors, some people with self-directed IRAs, other funds. To give an idea, over the last 5 days, we have received close to $500 million in tapes or assets of loans that consist of, I don't even know how many thousands of loans. So it's not, it's a market that is still, a lot of product that is out there. You want to add anything, Lauren?
No, you covered this one.
I like to talk, especially numbers. So this next case study, this again goes back to what I mentioned in the last one about scale and being able to touch, and put your fingers on every loan. And I'll explain why in a minute. This was a loan. It was in Wisconsin. Property value, again, around 100,000. Payoff was 70,000. We acquired this one at 50 cents on the dollar. The borrower was making a payment of $850 a month at, again, an interest rate of 9.9%. Same thing. The loan was originated around 2012-ish timeframe. And, the person had been making 5 years of payments in the property. For, it's a, cute little cape in the area. It was maintained. It had the equity. And, what was the predicament? The predicament was the borrower got divorced. And then also had some health issues as well. So again, it's something that, is one of those unforeseen things that is a life-changing event. And this was kind of, again, a first off with that investor. And when we paint this picture, these are types of loans that, we like to, acquire and work with, where we feel we can create that win-win resolution with the borrowers. Anything you want to add, Lauren?
Nope, you're going great.
So I mentioned a minute ago about scale and size. So this borrower filed Chapter 7 bankruptcy after getting divorced. And there's two types of bankruptcies, which I'm not going to get into in a big nutshell. But in Chapter 7, all your debts are wiped. So you don't owe anybody any money. Okay. So if it was your credit card debt, anything that was unsecured, that all gets wiped away. A lot of borrowers think they get a free house because they're told you don't have to pay your mortgage anymore, which technically they don't. They don't owe you the money. But the mortgage allows us, if we don't get paid, to redeem, take legal action against that person. So we just can't go after them for any payments, but our right is we still can go back and take that property, which is what's called a secured asset, which is, mortgage notes, real estate is a secured asset. The other component with a Chapter 7 is because they don't owe the debt, the servicer is not allowed to contact them. So this file just sat there doing nothing for over a year because nobody reached out. And the seller never realized, that, oh, we should probably reach out to this borrower and see what they want to do with the property. So when we acquired it, we had our attorney contact their bankruptcy attorney and say, essentially, hey, look, the borrower on their form said they wanted to keep the property, but they never signed what's called a reaffirmation agreement, which is, it's a document that states, hey, we're going to start paying again, and it reaffirms or puts the debt back on the property or back on them. And once that happens, you can start communicating again. So, basically the borrower again was 2 years behind, and we reached out to their attorney. We got them to sign that reaffirmation agreement. And then once they signed that, the borrower, again, hear from the borrower, oh, I didn't think I had to pay. That's something we hear a lot on Chapter 7s. And then we worked with the borrower because of their situation, where we modified the loan and reduced the payment down to $700 per month. And then we held this loan for about 30 months. And this one, because the borrower was on ACH, just making good payments. It was one that was cash flowing in our portfolio. We didn't have a need to sell it. So we held on to it. And then eventually, as we were liquidating some assets, we sold this loan after about 30 months. We received payments during that time, since we got that resolution, plus sold the loan for $55,000. Again, another nice double-digit return for us on this asset.
Yeah, I think something that I personally hear often from investors, is like, just why aren't banks doing this? Like, why aren't they working with borrowers like this? How can you guys do this? Or, I think that there's like a little bit of a disbelief around like, this is actually people's situation, and we just do something that banks don't, is we look at each individual loan as unique. We are communicating with them, and like, these two cases are like perfect examples of someone just needs to reach out to them and give them the opportunity to communicate with us so that we would know what's going on. Larger institutions that manage, hundreds of thousands, of loans, that's just not the bandwidth they have and are able to do.
Yeah, interesting story. I'll talk about that because people ask that question. And speaking of banks, I closed a bank account back in May, and I closed it in the middle of May. And in April, I got, basically a monthly surcharge. And I'm like, wait, I closed the account and this, and stuff. And they're like, oh yeah, you're right, we did. And I'm like, okay, basically they're like, okay, we're not going to charge you. I have gotten, it's actually funny enough, they are calling me right now. I swear my phone is ringing right now, and it's that bank. I've been going for almost 6 months now, and they keep calling me saying, you owe the $25 fee. And I'm keep telling them, I've closed the account. I've spoke to XYZ at the branch, and it's basically every different department you go to at these large institutions. It's, they keep tripping over themselves. I won't name the bank, but it's at that type of scale, they are not meant to manage things on an individual basis. And I'm sure we've all had, between banks, credit cards, whatever the case may be, issues with them where you may have disputed something. And how simple was that process just to dispute a minor charge? Imagine trying to negotiate something on a $100,000 loan.
Yeah, so I just thought that was worth adding. This might be the least I've ever spoken on a webinar, but it's probably because I don't have much of a voice. So enjoy this. So yeah, that's really all we had today. Was we really wanted to bring you guys 2 examples of what does that look like when you say helping the borrowers. What are some situations you run into, and can you show us the numbers behind that? I think something else that's interesting to note that just dawned upon me is, I get a lot of questions about, well, interest rates are a lot higher now. How are you going to work with someone who has like a 3% interest rate? And I think, that there's a few things to unpack there, but it also, assumes that everyone who's going to apply for a home is getting like the best interest rate out there, which, as you can see, those 2 loans were originated in 2010, 2012, I believe you said, Chris. And interest rates were lower at that time. So those are higher interest rates than the low. But I can speak from personal experience. When my husband and I went to buy our first home, great credit, great jobs, everything, lined up. $150 AAA charge that was sent to a different address of my husband's knocked his credit like 30 points, and our interest rate up like a whole percentage. So something as minimal as that can affect it. I think we need to consider that not everyone is going to have, the best interest rate of the time. And then also look at the fact that, some of these loans that we're acquiring originated in 2010, 12, 15. So just another thing to take into account kind of dawned on me. I was like, wait a minute, we didn't even get the best interest rate because of like a $50 thing. So just another something I know that comes up a lot in calls.
Okay. A question came up that says, will you spend a little time on the payment returns? Understand you're targeting 8%, and do you see this going up or down? You want to start, or would you like me to start?
I'll let you take it.
So the targeting 8%, we do not see this going down. When we went through this offering, and Lauren can attest the number of financial models that I ran for this to analyze where we were comfortable targeting. The 8% was, I think, the low threshold of the fund. And again, we can't guarantee or promise any type of return, and no fund or any company can. And we do follow the SEC rules and regulations. Do we see this going up? I know the interest rate environment has gone up, which has had some impact on real estate. The potential is there for it can increase. At this point in time, we are 4 months in on the fund, and I don't like to forecast out or make any promises for 2 to 3 years out, but I can say that I'm very comfortable with the 8% providing that, and there is the potential where we could provide additional dividends in the future.
Another question just came in, and again, I don't know if this sometimes, well, we'll answer the question first. So what hedge do you take to protect yourselves from worst outcomes?
Yeah. So for us, there's, many different risk factors that look into any investment that we have to manage. In real estate, I think the one that most people think of that come first in their mind is real estate value. And that is, one thing we're definitely looking at right now, where when we're pricing assets, we're pricing in what we call price damage. So if someone's saying the property is worth $300,000 today, we're discounting that value. Because if we were to have to go through a legal process, which might take 12 to 15 months, what do we anticipate that home to be worth in 12 to 15 months? Our guess, nobody can predict the future, but I think most people would be, if you asked 100 people, probably 95 of them would say it would be lower, and 5 would be realtors who would say it would be higher. So that's one hedge that we do look at. And the other outcomes we look at, without going through a lot, is, the major risk factors are title of a property. We're buying a first lien. We want to make sure we're in first lien position. There's no title issues or claims that we have to do. We want to make sure taxes are paid, because taxes are one of the only things that could wipe us out. We send 2 different companies to go look at the properties to gauge their value and the condition of the properties, because us buying these is based off of an assumed value. We don't get to go inside these homes. So those are 2 of the major components that we look at. And then again, like we mentioned, what was the borrower's, picture.
Yeah. And I will say, because mortgage notes isn't like, the most out there new thing. But I want to talk a little bit about what that process looks like when we're acquiring, really quick, just to shed some light on how much goes into acquiring an asset. So we get a list of assets for sale. We essentially, the seller says, your initial bid is due Friday. We get it Monday, it's due Friday. We go through and look at their information that they're providing us, and we put bids based off of their information. Then if they accept our indicative bid, we have, essentially think of it like buying a home. When your offer is accepted, you have that escrow period where you then go and you do your inspection, you assess anything that might come up you want to ask for credits for. Similar to that, we go through, and like Chris said, we do send people out to verify property value. We have attorneys review title. We do all of this additional due diligence before we acquire and say, okay, yes, these prices work, or no, we need some concessions on these because title is not clean or whatever it might be, or choose that the asset doesn't fit our portfolio anymore because of something we found in the due diligence process. So, it's not, just we'll take it at these, we do a lot of due diligence that goes into it after they accept our initial bid. So just wanted to kind of walk through that process a little, because I know it comes up on my calls a lot.
Yeah. And not only do we go through that process, but we do it individually then as a team. So it's not just, one individual. We have individuals review initially, and then we review everything as a team.
Well, we did promise to keep it to 30 minutes today, because I know the other ones have been super long, but if anyone has any questions, feel free to drop them in the chat. I will see if we can answer a few more here. And while I'm giving people a final chance to ask any questions they might have, if you are interested in learning more, you have more questions, feel free to reach out to me directly. You can email me at lauren@70investments.com or invest@70investments, which is here. And either myself or Katie will schedule some time to talk with you and answer any questions you might have. Additionally, if you have questions surrounding, I know someone earlier, Chris just answered a question about risks and how we, protect us against those. We have done a whole webinar on that. I usually send them to people before we get on the call, and everyone has given great feedback on those being super informative and usually answers most of their questions. So on our YouTube channel, we do have 2 webinars, one that breaks down the offering and everything about it, and one that breaks down the assets and everything about that, and our approach to managing these assets. So go check those out if this is your first webinar with us. They are super awesome and informative, not just because we are on them, but because the information is great. And then, okay, we did get one more question. Are all the properties in a certain geographical area, or is there a diversity in the portfolio? So Christopher Sweiner asked that question. Yes, they're not in a certain geographical area. We are spread out throughout the US. We do have certain states we tend to, want to stay away from for various reasons, or the price point doesn't make sense, but we don't have like one specific area that we are located.
Yeah, we've invested in 42 states. So there was a question earlier I came on, I answered it online, but the question was, what was the minimum investment? In the minimum investment, I'll let you answer that, Lauren.
Yeah, so the minimum investment is, again, this is a Regulation A offering open to accredited and non-accredited investors. The minimum investment is $500, and we start offering bonus shares at $25,000. So again, if you're interested in wanting to know more about that, feel free to reach out to myself or Katie at invest@70investments.com. 1 minute over, we made it, and we're talkers, so this is pretty good for us. Thank you guys so much for your time. And if you're interested, next week, we are actually going to do a live podcast recording. That'll probably also be about 35, 40 minutes. And we will send out information on that. So stay tuned and join us next week.
Thank you all.
Bye.